Okay, so we are already aware that we are going to be meeting 5 questions in the exam hall. We are going to be meeting 5 questions in the exam hall. So question 1 will be on group accounts. Question 1 will be on group accounts. Okay, that will be for 20 marks. So the group account, they can give you okay. So question, they can give you the group account, they can give you statement of financial position. Okay, they can give you only statement of financial position, which you'll be doing for 20 marks. They can give you statement of profit or loss and other comprehensive income. Okay, they can also give you that one for 20 marks, or they can give you both. Okay, it's last they are giving you both. Okay, they can give you both, which was last sitting, they have given them both. Okay, whatever be the case, you are going to be answering the question 1 for 20 marks. Okay, if you are giving statement of financial position, you are going to be consolidating the parent and the subsidiary. The parent will now be, or the investor will now be the owner of the what? The investee. So if you are preparing your account, you are going to be adding the company that you own. So it doesn't matter when the acquisition is being done. Even if it is 3 months, even if it is 6 months, we still add the what? The statement of financial position figures. We add the assets and liabilities the way they are in the statement there. There's nothing like you are prorating or you are going to be finding 6 months of the PPE of the subsidiary. No. If you are selling your car to me on the last day of the year, the car is no longer your own. On the last day of the year, the car is my own. For statement of financial position, we don't do anything like 6/12. No. So you just take your figures, add the parent and the subsidiary together. If you are adding the figure, add the parent's assets, add the parent asset together with what? With the subsidiary asset. So the asset of the parents, and the subsidiary will be put together. So you have your asset and then the asset of the parents. So you write the parents here. The parents plus the subsidiary. So you add that one together. So you add it together. Okay. Then after putting your structures there, please, the equity items. If you come to the equity items, only the parent equity items will be shown. Okay, you show only the parent equity items. We don't, only the parent equity items will be consolidated, because the subsidiaries own will be net against what? The investment or the amount that the parent is paying for the equity shares of the subsidiary. The remaining portion will be shown as non-controlling interest, and that will also be shown as goodwill. So if you are giving statement of financial position, please just go and put the structure there, do your Kofi group or whatever group, then you put your asset there, then you just what? Add them, the parent and then the subsidiary. Associate is not part of the group, so we don't consolidate the associate. Don't add the associate figures to what? To the asset of the parent and then the subsidiary. We don't do it like that. Okay, so just add the figures, then you now move on. Okay, then you go to your workings. Your workings, what we'll be doing is that you have to show the group structure. Okay, you have to show the group structure. What is the parent percentage holding in the subsidiary? What is the acquisition date? What is the acquisition date? You show the acquisition date. What is the reporting date? You also show the reporting date. Then you show the post-acquisition period. The post-acquisition period is from the date of acquisition to the date that you are preparing the financial statement. How many years, how many months is that? Okay. Then from this one, you have to know the assets at the date of acquisition. So how much was the value, or how much is the value of the subsidiary before the parent is paying for it? Is the parent paying more or the parent is paying less? So if the parent is paying more, that would be a goodwill. If the parent is paying less, that would be a gain on bargain purchase, which will be taken to retain earnings. Okay. The parents, let's say the parents acquired the subsidiary on January to December. Okay. Let's say these are all 2021. Okay, 2021. Okay, 2021, the profit made over here. All right, 2021, the profit made over here will be for the owners of the. Oh, I want to use a charger. I want to use a charger. All right, sorry about that. So, okay, so the parents, let's say the parents acquired a subsidiary on January 2021. Okay, the subsidiary will operate from January 2021 to December 2021. The profit that they are going to be making over here will be for the owners, and part of those owners are the parent, which maybe let's say the parent is having 70, NCA will be 30. So you share the profit among these two. So the profit that will be made over there, which the profit is for the owners, and the parent is part of the owners. So parent will have a share of the profit. NCA will also have a share of the profits. Okay. You also have a share of the profit. Okay. So let's come to the net asset. What are the figures that you have to include under the net assets? Okay. So the net asset, you'll be doing it at acquisition. Acquisition will help you to do your calculation of the goodwill to know if the parent is paying more or paying less. Then you do at reporting. As reporting will help you to know the profit that has been made during the post-acquisition period. Okay. Please, the net asset over here is calculated from the equity side. Okay. The net asset, what we are saying, the net asset is our total assets. Okay. The net asset calculation under group accounts is different from net asset calculation under interpretation of financial statements. So this will be total assets minus total liabilities. Okay, total assets minus total liabilities. Okay, as against the total asset minus current liabilities when you are doing interpretation of financial statements. So what we normally use is that we find this one from the equity side. So you use the share capital of the subsidiary. The share capital at reporting will still be the same as at acquisition. Okay, because we want the percentage control to be the same. So if you're having 70%, we want to have that 70% at the end of the year again. So there should not be any problem there. Any other item under the what? Any other item under the equity, you bring it over here. So the question will give you return earnings at acquisition. You can also have revaluation reserves, or you can also have other reserves. They will give you at acquisition. They all can also have an item that we call share premium. Okay. You can also have share options. All those items that will be under the equity, you bring all of them over here. The question will give you at acquisition, those figures at acquisition. So you bring the acquisition figures here. Then you bring their reporting figures also here. So the question will always give you these figures at acquisition, or they will give you a clue to what? To calculate these figures. Okay. The standard says that at the date of acquisition, since you are going to be selling your asset to a third party, your asset must be sold at what? At market value or fair value. So at the acquisition date, all the assets will be fair valued. Okay, so you can see that some of the assets will be increasing. Whenever the asset is increasing, it means the liability will be the same. So if asset is increasing, liability is the same, it means that equity will be increasing. So if there is an increase or upwards adjustment at that date, the upwards will be what? Will be added. So the upwards will be added. Then you ask yourself, the asset that is being fair value upwards, is it a depreciable item? If it is a depreciable item and you are doing the acquisition at January and you are reporting at December, we are recording the asset at the start of the year. We are recording the asset at the start of the year. So if the asset is at the start of the year to December, we have used 1 year already. So you calculate the depreciation on that particular asset, and that depreciation will be shown as the depreciation will be shown at reporting, because depreciation is supposed to be taken out of profits. So you show it over here. The valuation can also be a downwards valuation. If it's a downwards valuation, it means that asset is reducing and the liability is constant. So the net asset will be reducing. So you subtract the downwards fair value adjustment from it. And this can also present a depreciation issue because the subsidiary will still be depreciating the asset on the original value. But that should not be the value. So they have charged excess depreciation, which was taken away from profit. So you bring your figures there and also do that adjustment. So let me just pass a double entry. Whenever there is an upwards valuation, what do we do? Okay. Whenever there is an upwards valuation and the question was silence about it, it means that this has not been done. So what will happen is that it will be assets. So the assets will be increasing. The subsidiary is still carrying the asset at the carrying value. So you debit your assets by the amount. Okay. You credit your net asset. Crediting the net asset means you are going to be adding. Okay. If there's any depreciation on it, then the depreciation will be debit your net asset, which will be net asset at reporting. Net asset at reporting, which will be dash here. Then you credit the assets. Okay. You credit the asset. That will be the same figure because depreciation will be reducing our asset. I saw the hand up. All right. This we don't have time. So if your hand is up, you need to speak up.
Hello, I have a question.
Okay.
Please, if in the P&L statement for the year end, they include, um, let's say, the share capital, you see retained earnings, and they write other reserves. Do you add it to the net acquisition, or the net acquisition beside the retained earnings, or you add it?
When they give you other reserves,
Yes, please, other reserves.
other reserves can be revaluation and other fair value gain. So it's part of the equity. You don't subtract, we add.
Okay, so you subtract from the retained earnings.
It is not part of the return. Other reserves can be revaluation gain or it can be fair value gain on instrument carried through other comprehensive income. Those items are not part of our retained earnings.
Okay, first. Thank you.
Uh, Preference shares are liability, so we don't add preference shares to net assets. We are only talking about you are buying equity shares. Equity shares are the only shares that will give you ownership. So preference shares are liabilities. So we don't add preference shares to the net assets. Preference shareholders are not owners of the company. We are looking for the value of the owners of the company. Okay.
Please,
Yeah.
hello.
Yeah, I can hear you. Yeah.
Yeah, please, other reserve treatment, is it at acquisition or at report?
The question will always give you information about that.
Okay.
All right. Okay. So you also show your non-controlling interest. You show your group retained earnings, and you also show maybe there are other reserves. You show that okay, you always have to be mindful of those issues and other post-acquisition adjustments. There can be trading between the two companies, so it can be intra-group trading. You always have to identify who the seller is. So you find your unrealized profits. If it is the statement of financial position that you are preparing, the person who is selling the items will be the one that will be including the unrealized profit in in each books. So you look for the seller and you whatever reserve is it, as soon as it's going to be under equity, that will be added. So if you have the reserves at acquisition, whatever reserve that they are talking about, whether it is general reserve, as soon as it's under equity, it is part of the shareholders fund. Okay, whatever reserves, as soon as it's under equity, it is part of the shareholders fund. Okay, Yes, please. If you are preparing, if there's an other component of equity item over there, the parent will take each share of the other component of equity to profit to their revaluation reserves or other component of equity. So you find a portion that will go to retained earnings. Retained earnings is only the ordinary profit items that will go there, profit from ordinary activity. So you always have to take your other component of equity from that. And we have solved questions on that as well. So you always have to separate the two. Okay, you always have to separate the two. But for NCI, whatever you are going to be doing, NCI will be getting the same figure. But just that if you have your increase in the retained earnings, let's say our post-acquisition profits that you calculated from the net asset table was 3,000, but there's an increase in OCI of 500. Okay, the actual profit should have been 2,500, which is profit from the ordinary activities. It is this profit that the parent will be taking to retain earnings, but their share of the 500 will be taken to other components of equity. But the NCI will be taking the share of all of these ones because NCI will take the 2,500 to their NCI and they will still take the 500 to their NCI again. So NCI will be taking the share of all the 3,000. Okay. And the parent will be taking 2,500 to share of 2,500 to retain earnings and the share of 500 to other component of equity. That is if the parent is having other component of equity and the subsidiary is also having other component of equity during the post-acquisition period. Any other question? Okay, let me just open the question for you. I will not say anything again. So just bring your questions. We are on consolidation. Okay, so let me look at this person's question. What if you are not giving retained earnings at acquisition? How do you calculate? The question will always give you information on that. So the question will always give you information on how the retained earnings will be calculated. So they will give you profit for the year, or they will give you profit for the year and they will give you the retained earnings at reporting. So maybe that might be a mid-year acquisition. So you find your profit or post-acquisition profit and take it away from your reporting figure. Okay, so you take your post-acquisition profit from your reporting figure. So the figure that you are going to be getting will be your what? Retained earnings at acquisition. Why are we including the share premium? The share premium is for the equity shareholders. They are buying the shares at a higher value. So the share premium is for the equity shareholders. Okay, so if you are buying the share premium in addition, and you have to pay for the share premium. Okay, the share premium is a value for the equity shareholders, but we want to separate it. The shares are valued at 1 cedi. So if you are selling at 1.5 cedis, it means that 50 pesos should be put in a different account. We should have added the 50 pesos to the shares because the shares are for them. But we keep that one we keep that one in a different account. So if you are coming to buy, it means that you are buying the share premium in addition. So the share premium will be part of the equity items. Okay, senior, let the questions come, but finish with what you have started so that answer after, or some of the questions may be answered when you go on. I don't think you'll be talking just about console. Okay, thank you. So, okay, yeah, we all have knowledge about the consolidation already. Okay, so let me just pause with, I don't want to, we have less than 1 hour or we have 1 hour more. So maybe if you want to do the talking from question 1 to question 5, then maybe I will take all the time. So we have knowledge about the consolidation already. Just bring the question on that, then we look at it. Yeah, Auntie Sika.
Hello, sir.
Yes, please.
Please, when it comes to intra-group transactions,
Yes, please.
there are situations where sometimes the provision for realized profits is charged to only the parent's retained earnings, but there are some other situations where it's shared between the net assets of the subsidiary and the retained earnings of the parents. Can you kindly clarify when you should do what in what situation?
No, they will share it among the parents and then the retained earnings.
So sometimes with some questions, you see that when there is provision for unrealized profits, they charge the entire unrealized profit to the retained earnings of the parent.
Okay.
Yes, but there are situations to define the percentage
That is
holding of the parent.
that is investment in associates. Investment in associates will always be shared. So the parent will only take its portion. If the parent is selling to a subsidiary, the parent will take the full share of the provision for unrealized profits. The parent is the one that is going to be recognizing that. So if the sale is within the group, so let me just say within the group, okay. If the sale is within the group, which is intra-group trading, sale of goods. If the parent is the seller, it means that the parent is the one that will be reporting these as sales. So you find the provision for unrealized profits and send it to the group retained earnings, because the parent is the seller and they are going to be including the profit in their retained earnings. Okay, but whoever is the seller, the difference will be taken from the provision for unrealized profit will be taken from the inventories. Okay, if the parent is the seller, okay, or if the subsidiary is the seller and the parent is the buyer, okay, if the subsidiary is the seller, subsidiary is the one that will be including the profit element on the sale in their retained earnings, and their retained earnings will be at under the net asset, and the profit will be for the year, so it will be at reporting. The provision for unrealized profits will be taken from the net asset of the subsidiary if the subsidiary is the one that is selling. Okay, this is within the group. Outside the group, okay, outside the group, which will be between associates and the parents, okay, or associates. So outside the group, which might be between the parent and then the associate. If the parent is the seller, okay, if the parent is the seller and the parents have sold to the associates, okay, the unrealized profit will be shared among the owners of the associates. So if we are having only 30%, it means that we are going to be having only 30% share of of the unrealized profit. So you find only 30% share of the unrealized profit, which will go to the parent retained earnings, and the corresponding entry will be, you take it from the investment from associates. Okay, you take it from the investment from the associates. So that will be debit the group retained earnings with the parent portion, which will be maybe 30% of the total unrealized profits. Then you credit investment in associates if the parent is the seller. Okay, investment in associates. Okay, right now let's assume that the transaction is between the associate and the subsidiary. Okay, associate and the subsidiary. If it is between the associate and subsidiary, it is accounted for as if it is the parent, but just that the share of the unrealized profit will go to the net assets. Okay, so we debit the net assets of the subsidiary, which might be maybe it will be accounted for as if it is the parent that is selling through the subsidiary to the associate. So you find the parent share of that one, but just that the provision for unrealized profit will not go to group retained earnings because the parent is not the one selling. It will go to the net asset of the subsidiary, but the corresponding entry will still be, you take it away from investment in associates. Okay, you take it from investment in associates. So the situation where they will be sharing it is between the associate and the parent, or the associate and the subsidiary. But if it is between the subsidiary and the parent, the seller is the one that is going to be bearing all the provision for unrealized profits. Auntie Sika, are you okay now?
Okay. Yeah, thank you very much.
Okay. What again? What again? Do you have any other issue again on the group accounts? Please, you always have to pay attention to it is the intra-group transaction that is going to be worrying you. We can also have a transfer of PPE, a sale of
Hello, sir.
PPE. Yes, senior.
Yeah, so with the explanation you just gave,
Yeah.
you are saying if the parent is the one making the unrealized profit, that means if the parent is the one who sold the inventory or whatever, the goods to the subsidiary, that means the unrealized profit will be deducted from the retained earnings of the parent.
Exactly. The parent is the one that recognizes the transaction as revenue. So the
Okay.
profit is part of their retained earnings.
Okay. So that means if it is the associate selling it, it will be shared, but it will be taken to the net asset calculation of the subsidiary.
No, if it is a subsidiary that is selling to the parents,
Uh-huh.
okay, the subsidiary will be the one that will take the unrealized profits. Okay.
Okay, but are you supposed to take the unrealized profit to the net asset calculation
Yes,
of the
net asset.
subsidiary?
Yeah, because the retained earnings for the subsidiary is under the net asset.
Okay. Okay.
All right.
Thank you very much.
All right. I saw a hand up. Yeah, please, if you know your hand is up, just I don't have to mention your name again.
Okay, so please,
Yeah.
I have a question, and it's about the cost of investment.
Okay.
So I came across a question where, let's say, they say the cost of investment in the subsidiary is about 500,000, and then the cash payment of 400,000 was made.
Yeah.
And then the remaining 100,000 was paid at a later date. So in this case, if you are preparing the goodwill and considering the cost of investment, do you send the 500,000 or you record the 400 as the cash consideration and the 100,000 as a deferred consideration?
The fair consideration will always be having a financing component. Okay. What it means is that the cash that you are paying right now is 400,000. Okay. But the 100,000 that you are paying in the future, if you should have cash today, you are not going to be paying the 100,000. So it means that because of you holding their money, they are charging you interest on that particular amount. So you always have to find, if you should have cash today, how much should you have paid? But because you don't have cash, you are paying 100,000 at a later date. So you always have to find a present value, which is the cash, which is the principal component of the amount that you are paying. So the deferred consideration will always come with interest. So you should be able to separate the principal payment, which is the amount you should have paid today, plus the interest. So they will always give you the cost of capital of either the subsidiary or the parents. So you use the cost of capital to present value the deferred consideration. So you use the present value of the deferred consideration, which is the principal payment. If you should have cash today, then you add it to the cash payment. The difference will be a finance cost. So let me just use illustration. Assuming you are paying in 2 years' time, okay. But if you find the present value is 80,000, okay. If you should have cash today and pay, it is 80,000. But because you are not paying today, these people are charging you interest of what? 20,000 because of time value of money. So if you want to calculate your goodwill, you use your cash that you have paid plus the amount that you should have paid today for that particular one, excluding the interest. The interest is not something that you have to pay today. You are paying the interest because of what? Because of you holding the money for a particular time. But if you should have cash today, you'll be paying 400,000 plus the 80,000. So your purchase consideration or cost of investment will be 480,000, and the 20,000, which is the finance cost, now will be amortized over what, 2 years, or will be unwinded over 2 years. Okay, so you always have to find the cash component of the deferred consideration using the suitable cost of capital that will be given to you. So it's just like discounting. Okay, are you okay?
Yes, I'm okay.
All right,
Thank you.
you're welcome.
Hello, sir.
Yes, yeah.
And the unwinded value that you find, are you going to take it to the P&L as finance cost, or you are going to take it to the statement of financial position as a non-current liability?
It depends on which of the statement that you are preparing. If you're preparing statement of profit or loss, the finance cost for that particular year will be added to the finance cost for the statement of profit or loss. Okay. But if you are preparing
Okay.
statement of financial position, this is supposed to be taken from profit, but it has not been taken. So the parent will take that one from their group retained earnings. Okay. But what will happen is that
okay.
you haven't paid that particular interest yet. So you go and add
Yeah.
it to the principal. So we are owing them 80,000. Okay. So assuming this is for 2 years, it means that we'll be having 80,000 as the current owings, but we need
Yeah.
to pay interest of 10,000. We haven't paid that, so it means that the balance will now increase by 10,000. So at the end of the year, we're
10,000.
supposed to pay them a total amount of 90,000. So the finance cost
Oh,
will
okay.
always be added to what? Added to the deferred consideration.
Okay.
All right. All right.
Yes,
Yeah.
I think I have another question, please.
No problem.
And it is still on the contingent consideration.
Okay.
I would like to just read a snap of it so that you better understand.
No problem.
So it says that at the date of acquisition, applicant assessed the fair value of its contingent consideration at 4.2 million Ghana cedis. But by March 2010, it was clear that the actual amount to be paid would be only 2.7 million. Ignore discounting.
Okay.
So in this case, when you are preparing the goodwill,
You use the one at the date of acquisition. The one at reporting, you are just now, it's just like a provision that you are reassessing the provision. Okay.
okay,
So the one given to you at acquisition date, sometimes they can give you the contingent consideration is different from deferred consideration. Deferred consideration, you are going to be paying to the person regardless of what is going to be happening. But the contingent consideration is based on a performance that you are saying that if you're able to achieve this, if you're able to do this, we are going to pay this. But at the date of the transaction, this is the amount that you are estimating to pay the person. So use that. That is the amount that you are currently owing. Maybe during the year, there was a drop in performance. That is a during the year issue. So you have to revise your consideration now. So any increase or decrease will be treated as a movement in liabilities or a movement in what? Profit or loss. So if you're having 2.5 at the beginning of the year, you use the 2.5 in calculating your goodwill. That is the value of the consideration as at today. By the end of the year, if it is now 2.7, it means the liability has increased by 0.2. This will be a cost to the parent. So this will be charged as an expense to what? Group return earnings of the parents. Okay, if there's
and
a
if it was
reduction,
a reduction,
it will be treated as income. Your liability is reducing, that is an income. So that will be taken to group return earnings, and you will now reduce your contingent consideration to the actual value now.
okay.
All right.
Okay, so in that case, the contingent consideration that will go to the balance sheet will be the actual value?
The one at reporting date now.
Okay.
All right.
Okay, thank you very much.
All right. Yeah, I
Yes,
saw. Yes, please.
So, can you kindly give a scenario with respect to retained earnings?
Okay.
Where the acquisition is maybe 2.5 years, but then at reporting, a total figure was given, maybe balance retained earnings at the beginning and then at the end.
Okay. If you are giving two figures, please, can you come again?
Okay, so I was saying that within earnings, there's this balance brought forward,
Okay.
and then and then balance brought down.
Okay.
And the acquisition too is like a mid-year acquisition.
Okay.
How you should be able to recognize?
So you have the balance brought down that you are having. Is it the total return earnings at reporting or just the profit for the year?
Okay, so we have the profits for the year,
Okay.
and then the balance brought down.
Okay, so you just ask yourself, the profit for the year is for 12 months. Okay, within that 12 months, these people have operated for how many months before you acquire them? So it can be like this. So the balance, they can give you the return earnings. Maybe they can say balance at the beginning of the year. It can be 20,000. Okay, and the profit for the year can be like, let's say 50,000. Okay, and their reporting date is January to December. So on 1st July, you have acquired them. It means that they have operated from January to June before you acquire them. So on 1st July, what should be their return earnings balance? It should be the balance at the beginning plus 6 months profit, which is January to what? To December. So you just come here and find 6 month profit of this one, which will be 25,000. So it means that they have 20,000 at the beginning of the year. They have operated for 6 months before we acquire them, which is what? A profit of 25,000. So add these two and have your what? 45,000 as the retained earnings at acquisition. Or you can have your reporting retained earnings. Okay, this is at the beginning plus a full year, but they have done 6 months. There's a post acquisition of 6 months. So we acquired them on July. This is December. So it means that the 6 months that which is the period after we acquired them is part of this one. So you can also find yours minus 6/12 multiplied by 50,000. So you can do 70,000 minus 25,000. You'll still be getting the 45,000. So you just find the portion of the profit that was made before the acquisition and add it to the opening balance. That will give you the balance at acquisition. Please, are you okay with that?
Yes, please.
All right. I saw a question. How will you treat a dividend paid to the parents? Which of the statements are you talking about? Because if it is statement of financial position, the only thing that we can show over there will be maybe the parent is not receiving, or the parent has not received the dividends yet, and they will be showing that as what? As receivables, which will be canceling the payable. So which of the statements and how this statement will be presented? Okay, so if you can be more specific.
Yes, senior.
Yeah.
I'm referring to the balance sheet.
Okay, so if the question says that the parent has accounted for the dividend or they have not accounted for the dividends. Okay, let me just take the two. Okay, don't worry. Let me just take the two. Okay, let me just take the two. Okay. You see, under the net asset of the subsidiary, what retained earnings are you going to be using? It will be the retained earnings in the statement of financial position, which is already after dividend has been subtracted. Okay, so your profit that you'll be sharing over here, which is a post-acquisition profit, is a profit after payment of dividends. Okay, it will be a profit after payment of dividends. The question can tell you that, okay, so if the post-acquisition profit is 20,000, this is a profit after dividend. Dividend is not part, because retained earnings that will be shown in the statement of financial position is the retained earnings that will be calculated as retained earnings at the beginning plus profit for the year minus dividends. That's why we'll be going to the statement of financial position. So the figure that you are going to be picking as the post-acquisition profit is already after what? Dividend payment. Okay. If the question says that the parent is having 70%, but the subsidiary has paid a dividend of, let's say, 5,000. Okay. The subsidiary has declared a dividend of 5,000, or they are showing the dividend as what? As payables. Okay. The question can tell you that the parent has not what? Accounted for this particular dividend payment, or the parent has accounted for it. If the question says that the parent has not accounted for this, it means that the profit that should have been declared for the year should have been 25,000. That should have been the total profit that we should be having a share of. But we are having a share of 20,000 because dividend of this has been paid. So what will happen is that you have the share of this one, which will be 0.7%. Then you also have the share of the parent dividend over here, which will also be 0.7. So you'll be taking 0.7 of this one to retain earnings of the parents, and you'll be taking 0.7 of this one to retain earnings of the parents, so that you have a total profit of a share of a total profit of 25,000. So the dividend share of the dividend will be an income to the parents in addition to the post-acquisition what? Profit. Okay. If the question says that this has not been accounted for, it means that if the parents is coming to do 70% of the 5,000, the parent will be reporting this now as receivables. The subsidiary already have this as what? Payables. But if the parent is showing 70% of this as receivables, it means that will be intra-group balances. So the parent will not show each share of the dividend as receivables at all. Or the parent can show the share of the dividend which has not been accounted for. They have to receive 70% of the amount from the subsidiary. So that will be reported as receivables. So the parent will debit their receivables of 3,500, then they will credit their retained earnings of 3,500. But this 3,500 is due from what? A subsidiary. You cannot be owing yourself. So the parent will come and cancel the receivables that they are reporting, and they also go to the payables that the subsidiary is showing as 3,500. Okay. In effect, just report the share of the dividends, and you now remove the figure from what? From the payables. So you debit your payables with 3,500, then you credit your what? Your group retained earnings of 3,500, because the 3,500 will be shown as intra-group balances, because the parent supposed to receive that amount from what? From the subsidiary. Okay. But if the question says that this has not been accounted for, but if the question says that this has already been accounted for, and the parent has shown its figure as receivables, it means that the 3,500 has already been taken to retained earnings. The only thing that you are coming to do over here is that the parent will be having receivables of this, the subsidiary will be having a payables of 3,500. Go and subtract these figures from what? Their receivables and the payables. That will be intra-group what? Balance. Okay. But if it is statement of profit or loss, and the parent is showing the 3,500 as investment income in statement of profit or loss, no, that will not go there. This will be treated in statement of changes in equity. So you have to go and remove the share of the dividend from the investment income. The share of the subsidiary dividends, which the parent is receiving, is a statement of changes in equity item, not statement of profit or loss item. So, Senior, I don't know whether I've touched on your issue there. Okay.
Yes, I'm very okay.
All right.
Thank you.
Yeah. Senior Dennis and Auntie Grace, let's take your one, then I'll move on from this one to the standards. Okay.
Okay, so I wanted to ask a question on dividend again.
Okay.
So let's say the parent, the subsidiary, during the post-acquisition period, they paid dividends of, let's say, 5,000 Ghana cedis
Yeah.
to the maybe the parent and the subsidiary. Then they pay to the parent and the NCI 5,000.
Okay.
So I went. How do you adjust that one? You adjust it in the post
The
net
question
asset as reporting.
the question no, if they say the dividend has been paid, we are using retained earnings in the statement of financial position. It means that the figure that we are using over the dividend is already taken out of it. Okay, so you don't have to come and adjust your net assets. The dividend has already been taken out of that figure. So the only thing that you do is that you just find the parent share of the dividend and take it to the retained earnings. But if the dividend is for post-acquisition, the dividend is mainly for post-acquisition. That is what you are going to do it. You just have to ignore the adjustment to the net asset, because if you are adjusting the net asset, dividends has been taken, which is 5,000. So their post-acquisition profit will actually be 25,000, which the parent will take 0.7%. It's the same as you sharing 20,000 to the parents and the parent taking 70% of the 5,000 again. It's the same thing. Okay, it's the same thing. So you just have to ignore that one and just find the parent share of the dividend to group retained earnings. Okay, but if that is for post-acquisition period, sometimes the subsidiary can declare dividend before the acquisition, and the parent will want to have a share of that. Okay, the parent will want to have a share of that, which we call pre-acquisition dividends. Okay, but this one, they haven't examined this one. The last time that they examined this one was the old syllabus. Okay, they can pay a dividend that is for the parent will say they are going to have a share of what? Of the dividends that has already been paid, pre-acquisition dividend. What do we do? The assumption is that if the parent is paying 125,000 for the shares, and the subsidiary has given a share of pre-acquisition dividend to the parent. Okay, the assumption is that there is a 5,000 over here, which is paid for what? For the dividend that the parent is receiving. So the parent is actually paying 120,000. So we are paying the 5,000 for the dividend that we are receiving. So we will go and reduce our purchase consideration or cost of investment by 5,000, then we now bring that figure as what? As cash. We just reverse that particular transaction if it is a pre-acquisition dividend. But if it is a post-acquisition dividend, just ignore the net assets, find the parent share of that particular figure and take it to their group retained earnings in addition to the post-acquisition profits. Senior, are you okay now?
Yeah, thank you.
Okay. Okay. Who? Okay. Okay.
Senior, let me ask this one quickly.
Okay.
When we are doing the profit and loss, with the normal workings, the 5 workings, where should we end it?
The profit or loss, the only group structure will be needed if you are doing the major 5 workings. You are not going to be showing net assets. You are not going to be showing any post-acquisition profit again, because we do the net assets purposely to know the profit that will be given to NCI and the profit that will be given to the parents. But we are preparing the profit or loss already. So it means that the profit that will be given to them will be ascertained from the profit or loss account. So we don't do the net asset table again. Okay. If you come to NCI, we only show the NCI because we want to show the figure that will be in the statement of financial position. Okay. We only do that to show the figure that will be shown in the statement of financial position. We also do the goodwill calculation because we want to know the portion that will be taken to the what? To the statement of financial position. Okay. We also do the group retained earnings because we want to know the figure that will appear as retained earnings for the parents. But here is the case, NCI will not be needed. Group retained earnings will not be needed. Goodwill will only be needed when they are giving you a rate for the impairments. They can say that goodwill, consolidated goodwill is to be impaired by what? 10%. So it means that you have to know the goodwill before you calculate the impairments. So you now calculate the impairments of the goodwill. And the net asset at acquisition will be relevant over here. But if you are just giving a figure for the impairments, it's only group structure that is necessary. Okay, it's only group structure that is necessary. But if you are giving a rate for the impairment, then it means that you have to calculate the impairment. You have to calculate the goodwill yourself before you find the what? The impairment. Okay, how do you treat loan notes and interest on loan notes? What about a loan note? Is it that a parent is investing in the loan note or it's just a normal loan note? How are they giving a loan note? So yeah, can you be more specific about that so that we move on? Yes, Naruna, can you be more specific about
Sir, if the parents give the loan note
as part of consideration?
yes,
If it is as part of consideration, it will be treated, the amount given to them will be part of the consideration, added to the purchase consideration. The loan note will be treated as a liability to the parent, and the parent will be paying interest. So the interest will be taken to profit or loss or group retained earnings. If it is as part as what? If they are giving the loan note as part of the purchase consideration, just find the value of the loan note, then you add it to your purchase consideration, you treat that as a liability, and subsequently you charge the interest on it, and the parent will be the one that will be paying interest on that. So
the treatment as liability is dependent on if it has not been worked on already, if it has not been taken care of.
Yeah, mostly it will not be taken care of. So that will be the default one. Okay, mostly it will not be taken care of. Okay. So is that one that you're saying, or the parent investing in the loan note of the subsidiary?
like most of the question, if you see it, it's always like, is there like that? It's not. It's a normal
No,
loan note. It's not.
The parents will always invest in the loan note. Can be in 2 forms. It can be part of purchase consideration, or it can be additional acquisition the parent is making in addition to the equity shares. Okay, if it is additional acquisition that the parent is doing, okay, what will happen is that after the parent acquired the subsidiary, the parent will now be the owner of the subsidiary, and the parent will assume the liabilities of the subsidiary. So if you're assuming your liabilities, it means that the loan note that the subsidiary is having will become an obligation to the parent. So if the parent is buying back of that, it means that the parent is paying for what? For its own debts. So the parent will be showing the loan note as an asset, the loan note as an asset. The subsidiary will also be showing the loan note as a liability. This cannot be, you can't buy loan note in your own company. You are only paying back those people. So you have to go and subtract the amount that they are having, from this one. Okay. Sometimes they will tell you that you should look at the what? The interest rate. Okay, sometimes they can tell you that you should look at the interest rate. Maybe the interest rate, is it at a commercial rate or it is at what? At a subsidized rate. Sometimes you have to consider that and look up for the removal of the interest. Please ignore whatever is the case because you don't have those information available. So if we are removing the loan note, it means that the interest paid on the loan note should not be paid in the first place. So the subsidiary is treating the loan note as finance cost. You have to go and reverse the finance cost. The parent will be treating this as interest income. The parents cannot receive interest income from its own what company. So you are paying back your debt. So go and remove the amount that the parent is investing as part of their asset, which will be the loan note as an asset. Remove that, go to the loan note, remove that too. The interest that has been paid, please reverse the interest also. So the parent will receive the interest as income, reverse it. The subsidiary will pay the interest to the parent as what? As a cost. Reverse that one also. Okay, so it can be the two options over here. Let me take the last one on the issue on non-current asset transfer. Is it going to be part of the consideration, or the parent or the subsidiary is giving an idle non-current asset to any of these parties to use?
Both.
Okay, if it is both, okay, sometimes the consideration can be settled in kind. We don't have money and we can transfer PP. Okay, the PP or the non-current asset will always be given to the shareholders of the subsidiary at fair value. So the question can give you the current value of the PP to be 50 million. Okay, and they will give you the fair value or the market value to be 70 million. Okay, and they can tell you that the only entry made over here is to transfer the current value of 50 million from their PPE to cost of investment. No, the PPE should be given to them as 70 million. So it means that if you are giving it to them as 70 million, the entry should have been, we will debit our investment, which is cost of investments. We debit our investment with 70 million. We credit our PP by removing the 50 million over there. Then we now credit our retained earnings, which will be a gain on that particular transaction. Okay, but the only thing that has been done is that we take 50-50 here. So it means that the additional debit to investment has not been done. So the asset should be given to them as 70 million. You go and add additional 20 million to the 50 million to make it 70 million. Then a gain of 20 million will now be taken to group retained earnings of the parents. That is the first part of it. Okay. If it is a transfer, okay, if it's a transfer of a PP after acquisition, okay, the parent is now the majority owner, or the parent is the owner of the subsidiary. And if the parent is having a PP that they are not using, they will just transfer the PP to what? To the other branch, or which is the subsidiary that, okay, we can't buy the asset for you, so take this one and be using it. Indirectly, the subsidiary is using the asset on behalf of the parent. So if the parent is having the asset in their books at a carrying value of 15 million, if you are giving the asset, if the parent should be the one using the asset, they will still be using the 15 million. But now you don't want to use it. You are giving it to what? A company that you own. They will now use the remaining portion of the asset for the remaining useful life. So the asset should be given to them at what? At 50 million. Okay. Always we assume that the parent is carrying the asset at cost model. Okay. So if it is at cost model, the parent will now transfer the asset to them at the carrying value of the asset. But what normally happens is that this asset can be transferred at a fair value. Okay. So they can give you that the parent has transferred this asset at a fair value of 70 million, which should not be the case. The asset should be given to them at what? At carrying value. because you are sending the asset to your own what business. Indirectly, they are using the asset on your behalf. If the asset should be with you, you will be using the remaining 50 million over its useful life. So the asset should be given to those people at the current value, but mostly it will be given to them at 70 million. And they also present this 70 million in their statement of financial position instead of 50 million. Okay. So the asset should be at 50 million if the useful life, the remaining useful life is 10 years. If the asset is at 50 million, the depreciation for the year, let's assume it's a full year, would have been 50 over 10, which would have been 5 million. Okay. But the subsidiary is depreciating the asset using what? 70 million. Okay. They will be depreciating the asset using 70 million. So 70 divided by 5, 70 divided by 10 will be giving us 7. Okay. That will give us 7. Okay. The asset should be given at what? At carrying value. So the parent has recognized a gain of 20 million. This gain should be taken away from what? Okay, let me show how the parent will account for this. So the parent will de-recognize the assets from their books. They will now de-recognize the assets from their books. So they will have debit cash. Okay, they will debit cash of maybe they are receiving cash. They will debit cash of 70 million. They will credit the PPE at 50 million. Then they will recognize profit on disposal or profit on transfer of 20. No, you cannot sell asset to your own company. You are just giving the asset to them to use on your behalf. So this particular transaction should be at 50 million, okay, which is the carrying value. The subsidiary will also account for this like this. Okay, the subsidiary will debit their PPE. Okay, they will debit their PPE of 70 million. Then they will credit their cash or bank of 70 million. Okay, so it means that the parent should not consider this as a sale. So what will happen now is that we need to now remove the profits. The asset should be given to them at what? 50 million, which should have been debit cash of 50 million, credit PPE of 50 million. But there was additional cash of what? Additional cash of 20 million and also a profit of what? 20 million. Please go and remove the profit. So you go and credit, you debit your retained earnings to remove that particular profit of 20 million. Then you can credit cash. But why we don't credit cash? This is the reason that we don't credit the cash. Okay. The asset should also be shown as what? As 50 million in the books of the subsidiary. So it means that they have to come and subtract 20 here. Their cash will also be 50 million. So they have to come and what? The cash taken was 70 million. So they have to come and add 20 million back to the cash. So the parent will be subtracting 20 million from the cash. The subsidiary will be adding the 20 million to the cash. You can see that it is going to be zero effect. That's why we don't pay attention to the cash. We pay attention to only the retained earnings and the excess amount on the assets. So you remove the retained earnings of 20 million, which is the profit on the sale. Then you now bring the asset back to the carrying value of 50 million. If you should be using 50 million, the depreciation should have been 5 million. So it means that the asset should have been at 45. Okay. But since they are using 70 million, they subtracted 7 million. So they are having 63. Okay. So how much do we need to get 45? You subtract 18 from this figure to get the 45. How do we do the 45? What we do is that you go and subtract the 20 from your asset, which is 70 that they have included in their PPE. Go and subtract the 20 to down bringing that to what? To 70 million. But the depreciation that was charged over here was 7 million. But the actual depreciation should have been 5 million. So it means that they have overcharged the depreciation by 2. So you come and add this depreciation back by 2. And this depreciation should have been 5 million. The subsidiary charged 7 million. It means that their profit was undercharged. You go and add the excess depreciation also to the retained earnings. So let me just pass the entries for you so that you know what we do. Okay. If there is a transfer at fair value, the profit on it, you debit the group retained earnings. Okay. you debit the group retained earnings with the profits, which is 20 million. You credit the PPE of this one. So these people are showing as 70 million. It should have been 50. So we subtract that one from it. Okay. There will be excess depreciation. The excess depreciation, you debit PPE with the excess depreciation. That was 2 million. Then you credit the net assets, which will be at reporting, with that one being 2 million, because they should have charged a depreciation of 5 million, but they have charged 7 million. So they have overcharged their depreciation by 2 million by making their profit reduced by the 2 million. So you go and add that one back. That is how we go about it. Senior, the person with the issue on the transfer, are you okay? Can I move on?
Yeah.
All right.
President,
Yes, please.
yeah, I have one listen here.
Okay.
Where they say at the date of acquisition, the fair value of an asset is approximately equal to their current value, except mostly we'll be seeing a certain above. What of if it's in other way around, is below the current value?
If it is below, it means that the net asset will be reducing. Your asset is reducing. And so if it is below, it means that the carrying value was 20 million, but the carrying value should have been 18 million. Okay, so you have used 20 million to calculate your net asset. It should have been 18 million. So it means that you have overstated your net asset by 2 million. So you go and subtract your fair value upwards to be 2 million. You take the 2 million. Okay, your carrying value of the asset is still 20 million. You haven't taken this into consideration. Go and subtract the 2 million from your PP also, or whatever asset is that. Okay, so you subtract 2 million from the net asset at acquisition and also at reporting. This might be bringing a depreciation issue, so we look at that one also. So let's say the asset is 20 million, the carrying value is 20 million with a useful life of 5 years. Okay, they are saying that at the date of acquisition, the fair value of the asset is 2 million below the carrying value. So it means that the asset should have been 80 million at acquisition, but you included 20 million. Go and reduce it by 2 million. So you have your net asset reduced by what? By 2 million. You have also included a 20 million in your PP. Go and make it now 18 million. So you go and subtract the 2 million over there. But the question is, you have taken the asset at 20 million for the full year. So you have charged a depreciation on the 20 million. So this will be 4 million. But the actual depreciation should have been on 18 million. So if the depreciation is on the 18 million, how much are we supposed to be getting?
$3.6.
Okay, 3.6. So the depreciation that should have been charged should have been 3.6. But you have charged what?
4
million. You have overcharged your depreciation by what?
0.4.
So you count your net asset, you bring what we call the excess depreciation, which will be an addition. Okay, you add it to reporting. Okay. You have taken, this is how the subsidiary will be accounting for this one. In their PP reported in the statement of financial position will be 20 million, which is the carrying value, minus a depreciation of what? Of 4 million, isn't it?
Yeah.
Okay. Now you have subtracted the fair value what? The fair value loss. So this figure should have been 18 million minus what? 3.6. But what you are going to be having over here will be 20 minus 4 minus 2. But as far as you are reducing this one to 18 million, the depreciation should have been 3.6, not 4. So you bring the 0.4 back to now make this depreciation to be 3.6 by having 2 minus 2, 20 minus 2 minus 3.6, because this will now give you the 18 million. Then you now subtract the actual depreciation from that. Okay, so that's how we go about it. I hope you are fine with that one also. Okay.
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 Yeah, thank you.
Yeah, so yeah.
Hello. Linus.
Yes, please. I'm with you.
Hello.
Yeah, I'm with you, Senior.
It's Roxy. Please, I want to ask that.
Okay, can I pass the
general for this one?
But let me pass for this one. So this one, what will happen is that you debit your net asset. Debiting your net asset means that your net asset is equity. So debiting equity means that, so debit your net asset with 2 million, credit your PPE with 2 million. Then you come and you now bring the excess depreciation over there. So you now credit your net asset specifically at reporting 0.4. Then you now debit your PPE with the 0.4 in relation to the excess depreciation that has been taken. Okay. So can we now take someone wanted to say something?
Linus, it's Roxy.
It's okay now.
Roxy. I want to ask that.
Yeah.
Yeah. So when please, so with pertaining to goodwill, I say goodwill, business valuation. Please, when you are solving question under
No,
business valuation and there is an adjustment.
This is financial reporting class. Corporate reporting is done. Okay. So I don't want you to confuse my student for me. Okay.
Sorry.
Okay. Please, can you demonstrate?
Please don't confuse us, please.
Okay. Please, can you demonstrate it with the columns, with the transfer and then without the transfer, especially when the subsidiary is the one transferring? If the subsidiary is the one transferring, the reporting will be the same, but just that the profit element will be taken away from the net asset at reporting of the subsidiary. That is all. But the treatment will still be the same. Okay, the treatment will still be the same. So the profit of 20 million, which was on the asset, will be taken away from the retained earnings of the subsidiary, which will be at reporting. But who will be charging the excess depreciation? It will be the parent. So the excess depreciation will now be taken to the retained earnings of the parents. So it is the opposite. If it's the parent that is transferring, the parent will bear the provision for another spot, which is 20 million. But the subsidiary will be the one that will enjoy the excess depreciation. If it is the opposite, it means that the profit will be taken away from the net asset of the subsidiary, and the excess depreciation, the parent is the one that is going to be depreciating the asset. So they will be over depreciating the asset. So the excess depreciation will be taken to group retained earnings of the parents. The treatment in asset is still the same for the two. Okay. The treatment in asset is still the same for the two. Okay. All right. So please, can we move on from the consolidation now to standards? And for the standards, it is going to be final account will be included in the standards. So maybe I've always been telling you that don't go to the exam and do ratio analysis as the first question. No, it will not help you. Okay. Yeah, Sina Dennis.
It's counted question on the earnings per se. So if let's say you are giving at the beginning, maybe you are giving the outstanding test, and then maybe during the year, maybe around March, they had a bonus issue. Then let's say around maybe around June, they also made right issue. If you are calculating I'm assuming if you are calculating the right issue, let's say they give a right issue of 1 to 4.
Take it again.
Okay. So I'm saying, it's about the earnings per share. So I'm saying, but if they have at the beginning,
the network.
February they made a right, and then July they made a right issue again. How do you go about that one?
Okay. Someone sent
Hello.
a question. Yeah. Okay, Sina, I hope you can hear me now.
Yeah.
Okay. If you can take it again, because your network was.
Okay.
Yeah.
Okay, so I was talking about the earnings per share. If they ask you to calculate basic earnings per share,
Okay.
And around let's say first March, they made a bonus issue.
Okay.
Then following that one, maybe
Following the one, they made the right issue.
Yes, they made another right issue. They made right issue. The weighted average number of equity.
Okay. So what will happen is that this is what you are going to be doing. Okay. Let's assume that you have existing shares which are at the beginning of the year. So let me just use assume figures over here. So let's have existing shares of 10 million. Okay. Let's assume that the bonus issue was made before the right issue, isn't it? Okay. So there was a bonus issue. There was a bonus issue of made, let's say 145. Okay. Bonus issue of 145. The bonus issue will be made before the right issue. The bonus issue, it doesn't matter when it is being made. It will have impact on the shares that are in existence before the bonus issue. Okay. So let's say the bonus issue, their year is January to December. Okay. So the bonus issue was made on, let's say, 1st April. It doesn't matter. Okay. So the bonus issue, it is assumed to be in existence on existing shares before the bonus issue. So it means that the bonus issue of 145 will be made on this one. So we can decide to find the bonus shares on that one. So that will be 1/5 multiplied by 10. Okay, we are going to be having 2 million. So the existing shares, including the bonus issue, will now be existing shares, including the bonus issue, will now be 12 million. Okay, let's assume that the right issue has been made on what date? Can we say 1st August? Let's say 1st August, a right issue was made. Okay, the 1st August, a right issue was made. What you have to know is that the right issue is always coming with what? A full market value and a bonus issue. Okay, the right issue will always come with a full market value and a bonus issue. So what you have to do is that you have to find the value of the share. Okay, someone sent a question. Let me see if I can use that question to demonstrate whatever I want to do. So let me check. A minute. Okay, let me check this and
Yeah.
okay.
Yeah.
Okay, so let me use this one to just solve. Okay. So the reporting date of the entity is 28 February and their financial year starts from 1st March. Okay, so on 1st March 2015, Jamasi PLC had 30 million issued equity shares. On 31 May 2015, the entity issued at a full market price 6 million equity shares. Okay, on 31 December, the entity made a right issue of 146 at 7 million, the fair value of the shares on the last day before the issues from the right issue was 10 million. Earnings for the year ended 31. This one is this amount. Okay, this is actually a full market value and a right issue, which is slightly different from what our Sina Dennis is asking. But I can use this one to maybe let me solve this one and see. Okay, so I can use. Okay, let me explain your own first, because your own is about bonus issue and a right issue. So let's assume that the right issue on this date, was right issue was 1/4. Right issue was 1,144. Let's say at a price of 5 cedi, or let's say at a price of maybe 3 cedi 50 pesos. Okay, the question will always give you the market value. So maybe let's say the market value of the existing shares before the right issue, market value of the existing shares, let's say it was 5. Existing shares was 5 Ghana cedis. Okay, so what you have to do is that you always have to find a theoretical extra price, which is the value of the share after the right issue. So I'll use the unit approach over here for you. So we look at the existing shares. Okay, existing shares, we are bringing 4 of the existing shares for 1 new shares under the right issue, and these shares are valued at 5 cedi. So you'll be having a weighted of 20. You come to the right issue here. You'll be giving one share at 3.5. So this will give us, so let me just make this one to be 4 so that maybe we can get absolute figures and move on. So let me just make this one 4 cedi and this one to 4 cedi. So this will give us 4. So our total will be 24 and our number of shares will be 4 plus 1. That will give us 5. Okay. So you can find your theoretical XY price to be 24 over 5. What are we having?
4.8.
4.8. Okay. So what is the number of shares that we are going to be getting from the right issue? The right issue will be made on the existing shares, which is 12 million. Okay, it is the 10 million plus the bonus issue. The bonus issue was done before the right issue. So the right issue will be done on the bonus plus the existing shares. Okay, that will give us 12 million. But the right issue is 143. How many shares are we going to be getting from the right issue? Would that be 3 million?
The right issue is what?
It's 1 for
So with
4.
3 million.
Okay.
1 for 4. It will be 3 million.
Okay. So the right issue will be 3 million. Okay. So the right issue shares will be what? Will be 3 million. Okay. So that will be 1 over 4 times 12. 3 million. You see, 3 million out of these 3 million, certain number of shares are for full market value, and certain number of them are for what? Are for a bonus issue. So the shares should have been issued at 4.8, but we are issuing the shares at 4 million, which is the right issue price or the offer price. It means that these shares are issued at 0.8 what? Bonus. So what you do is that you can separate the full market value from, you can separate the full market value from the what? The bonus issue. This shares will be issued at 4.8. So full market value will be 4 over 4.8 multiplied by total number of shares. Okay. Bonus issue will give you 0.8 divided by 4.8 multiplied by the 3 million. What are we getting for the 2? I'm getting 2.5 for the first one. And this will be 0.5. Is that correct?
Yes, please.
Okay. So this is the bonus issue. Bonus issue are assumed to be in existence from the time that the company has started. So your weighted average number of shares will now be existing shares will now give you, okay, your existing shares will now be the 10 million plus the normal bonus issue plus the bonus issue from your right issue. So we have 2 million as a normal bonus issue. Then this will now give you 12.5. So you now have your full market value. Okay, your full market value will now be the 2.5 shares, which will start from 1st August to December. August, September, October, November, December. That will be 5 months. So you just do 5 over 12. What are we getting? I will show you another way of. Okay, I'm getting 1 point. This figure. Okay, that will give us 13.54. Okay, that is the easiest way of doing it. Another way of doing it is this one. You can also have the existing shares. Okay, if you have the existing shares, this is what you'll be doing. Okay, the existing share, you ask yourself, the existing shares has been there for how many months before the bonus issue? It has been there for 3 months, isn't it? So it has been there for 3 months. So you do 10 multiplied by the bonus fraction of 6 over 5 multiplied by the right issue fraction. The right issue fraction will be 5 divided by 4.8, which is the cum X price over the theoretical extract price, 5/4.8. So the bonus issue on the right issue also affect the existing shares. So that will be 5/4.8. Then 5/4.8 multiplied by first
4/1.
Oh, it's 1st April.
4/2.
That will be 3/12. 1st April.
3 months.
Okay. So you now come here,
Okay.
you come to this place. What will happen now is that you will be having, before the right issue, the shares will still be 12 million. We'll be having the 12 million over here. So we have 12 million multiplied by the bonus issue will affect this one too. The right issue over there will multiply by this one. And that is going to be giving us April to August. How many months is that? Okay, I'm sure that will be 4 months, 4/12. Then you count, this will be
Which
April.
day in April? Is it first? If it's
Yes,
first, it's 5.
April, 1st April to,
Yeah, it will be 5.
it will be 5.
To August first.
Okay, so
August
August to
1st,
December is what?
4.
Okay, so this is supposed to be 4, sorry. So we have 4/12. Okay, so let's have 4/12 here. Okay, I'm having 0.83. Okay, 0.83.
$13.33.
Okay, 13.33. Okay, so that will be 5. This will be 5 months. Okay, okay. So you count to April to August will be 5 months. So you now have August to December. August to December, you now have your total number of shares. Your total number of shares will now be the 12, which is a bonus issue. Then the right issue of 3 million will now be added to it. You'll be having 15. So 15 multiplied by 4/12. Okay. But this seems to be more complicated. You'll be getting the same answer at the end, but this seems to be more complicated. Okay. So you apply the bonus issue first on the shares. You'll be getting 12 million. Then you count your right issue. The right issue will be made on the existing shares, which is what? The 12 million. So you'll be getting 3 million. You ask yourself, which portion of that shares represent a bonus issue? So the bonus issue, you just come and add it to the existing shares like that. It is the full market value of 2.5 that will be contributing to the profit from the date of the what? Of the issue. So just separate the bonus from the full market value. Okay, any of the method that you are comfortable with, you are good to go. You apply the what? The bonus fraction up to the time that the bonus issue has been done. Then you also apply the right issue fraction up to the time that the right issue has been done. Okay. All right. So let me make reference to this particular question and show you how you can calculate this one. The time is already gone and I have different things to do. So I'll just leave it over here. Then if you have any other concern, you can just put it on the page. I will address them. Okay. So they have 30 million at the beginning of the year. So they have the existing shares. Let me address that for you. Existing shares is 30 million. Okay, let's count to the full market value. Okay. They have made a full market value of how much? Full market value of 6 million. Okay. They have made a full market value of 6 million. Okay. Then let's count to this full market value. They have made a right issue on what date? They have made a right issue on December 2015, right issue of 146 has been made. Okay. Before the right issue, how many shares will be there? Before the right issue, how many shares will be there?
It will be 30.
No,
36.
36.
that will be 36. Okay. So that would be 36. So the right issue is 146. Okay. So that will be
Okay.
36. And the right issue will be 146. So let's go to the right issue there. So I will just do the two for you so that you pick the one that you like. So the right issue will be made on the shares in existence before the right issue. So 1/6 multiplied by 36. We're having 6 million. Okay, let's find the theoretical extra price. So we'll be having the existing shares. We have the existing shares of, we are bringing 6, and this is value at what? The question has given you the value. So they say the value of the shares on the last day before the right issue from the right issue was what? 10 cedis. Okay. So this
10.
will be at 10 cedi, and this will be 60. Let's count to the right issue. Okay, the right issue, we are taking one share at 7 cedi. So this will give us 7. So we'll be having 67 and what? 7. Our theoretical extra price will give us 67/7. What are we having?
9.54. It's 57.
Okay. Are you approximating it?
It's 9.5714. So
Forget, just make it just make it the 67 over this one. Okay. So the 67 over this one, if you want to, okay, the shares is supposed to be issued at 67/7. That's supposed to be the value. Okay. 67/7. Okay. So I will show you if you want to separate the two. Okay. Let's separate the two. Okay. The shares were actually issued at what? The offer price was what? 7, isn't it? The offer price was
Yes.
what? Or was at 7. Okay. If the
Yes.
theoretical extra price supposed to be 67/7, what would be the bonus one?
10/67/7.
Okay. It will be the bonus issue price. The bonus price will be 67/7 minus 7. What are we having? Would that be
67/7 minus what?
7 minus 7?
18/7.
18 over what?
7.
Okay. That will be, so the bonus price will be 18/7. So we have 18/7. Okay. So the bonus price will be 18/7. So we can just find the portion that is for the bonus price. This is going to be, because this is decimal, is going to be worrying you. So 18 over the price itself, which is 67/7, that is going to be worrying you a lot. So let's just stick to the what? The other one. So this will be worrying you. So we can't separate because of the fractions. We cannot actually separate the bonus one and use the other alternative one. So this is what we are going to be using now. Okay, this is what we are going to be using. So let's find our shares now. So let's have our existing shares. Our existing shares will now be, okay, the existing shares will be 30. Okay, that will be 30 multiplied by the right issue fraction. What are we getting?
$287. Hello?
No. This supposed not to be the right issue fraction. Okay. The right issue fraction is supposed to be 10 divided by this figure. Okay.
Yeah, it's 10 over 9.6.
Okay. So it's supposed to be right issue supposed to be 10 divided by 67 over 7.
9.6.
Okay. So we have 10 multiplied by 7 over 67. Would that be 70 over 67?
Yes, please.
Yeah. But when you express it further, you have 9.6.
Okay. So what are we having? If you multiply, what are we having?
Okay. Times 30, right?
Yes, please.
2001 over 67 or 31.34.
Okay, just make it the decimal. Okay. 31.34, isn't it?
Yes, please.
Okay. 31.34. Okay. But the shares were what? The shares were 30 million, isn't it? Okay. It means that this has increased by what? 1.34. Is that the case? Is that the case?
Yeah, the bonus 1.
Yes, yes.
Okay. So the 1.4 over there represent the bonus issue on the existing shares. Okay. And the bonus issue will be done out of the right issue. Let's count to the full market value also. The full market value, you also have to do the separation. The full market value will be 6 million. So we have 6 multiplied by 70 over 67. What are you getting? The right issue will affect the full market value because it has been there before the right issue. I'm having 626 or 627.
627, yeah.
Okay. But the shares was what? The shares was 6 million first, isn't it?
Yeah.
So how much the share has increased by how much?
2.7. 0.27.
Okay. So the 0.27 is also the bonus issue that is out of the right issue on this one. But this will do how many months?
The 6. I think you do 3 months.
Now, the reporting date is, let's look at the reporting date. So on 1st May to February, 1st May to February, that will be how many months?
That's 3 months.
No, 1st May this year to February next year. 31st May.
1st May this
10 months.
So it's the same year.
No, it's 2016. The reporting date is 2016.
Oh, okay.
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 So 31st May. So June will be 9 months. Am I correct?
Yes, please. 9 months.
So it means that their shares will do 9 months. Okay. So these shares together with the bonus issue will do 9 months. Okay. But the total shares that we are getting from the bonus issue is 6 million. Okay. But 1.34 relate to the right issue is 6 million. 1.34 relate to what? Relate to a bonus issue that is on the existing shares, and 0.27 relate to what? The full market value, which is 6 million. What will be the remaining value?
$4.39.
Okay, that 4.39 is the full market value, which was down on 31 December. So that will be January to February. That will do only 2 months. Okay, that will do only 2 months. So 4.39 multiplied by 2 over 12. Please put the answer there. Then we go to the other one about this one. You'll be getting the same answer. Okay, the one that you like, you can pick any of them. There is no one way of calculating your work. Okay. So 6.27 multiplied by 9/12. I'm getting 4.70. Okay. 4.39 multiplied by 2/12. I'm getting 0.73. What are you getting as a WACC? I'm having 36.77. Is that correct? Can someone confirm that so that we move on?
Yes, please.
Okay. Let's try the other one that we know. Okay. Where you apply the right issue fraction to the date that the right issue has been done. So we count to the existing shares that will be there from March, okay, March to May, okay, because the full market value was done on May, okay, so that will be March to May. So we have March to May, that will be 2 months. So we multiply the 30 million by, so we have March to May, that will be 30 million multiplied by the 70/67 multiplied by 2/12. Okay, multiplied by 2. Is it going to be 2/12? March to May, first
Yeah,
March.
first March to May ending.
Okay, that is 2 months. So you now have May to the time that the right issue has been done. That will be December. Okay.
Yeah.
So we now have 36 million because the full market value will be added to the existing shares of 36 million multiplied by the right issue fraction 60/7 multiplied by 10. Is it going to be 10 or 8?
May ending. No.
Okay, so let's make it June. June to December.
June, July, August, September. It's 7.
That will be
7 over.
Okay. So March ending is what? Okay, this will be 3 months. Okay.
Yeah.
March ending is 1 month, April ending is another one, and May ending. So this will be 7/12. Then we now count to January to what? To February. That is after the right issue. And this will now be the existing shares plus the full market value plus the right issue. That will give us 42 million multiplied by 2/12. You can put all of them together. So let's find the answers for them. The first one is what? And it's 7.84.
Yeah, 7.84.
Can you explain the origin of the 72? Hello.
Yeah.
Please, can you explain the origin of the 72?
The 70/67 is just we are looking for the right issue fraction, which is the same as the market value divided by theoretical extra price, which is 67/7. So this is the same as 67/7. So 10 multiplied by 7/67. So 70/67, which is the right issue fraction. Okay. Are you okay with that now?
Yeah, I'm okay. Thanks.
Okay. So the second one is what?
21.94.
21.94. Okay. Let's count to the last one.
7.
Okay, 7. So you can put them together and check. So 7.84 plus 21.94 plus 7. You should be having
36.78.
Okay, which is the same as almostly the same as this one. Okay, so any one that you prefer, you can use the one that you like. Okay, someone is talking about.
I have a question.
Yes, Senior.
So the seven
Senior, your
is
voice.
the bonus part. So it will affect both the outstanding mark. I was saying the bonus fraction, the 72 assessment. Yeah. The
Okay,
shares outstanding before the right
and also the
it will
full
affect
market
also the
value.
shares outstanding.
Yeah. So all the shares that were there before the right issue,
So it
the
will
right issue
affect
was
both
done.
the
Yeah,
shares at the
exactly.
outstanding at the beginning.
And the full market value.
What about if there is another? We have another question. What about there's another bonus issue after the right issue. There's another bonus issue.
So the
that one
bonus issue,
also
the bonus issue affects the existing shares together with the right issue. So all those shares that were there before the issue is done, it will affect all of them. So it will affect the right issue on. So if the right issue is on this one, it will be the right issue fraction over here. The right issue, the shares for the existing shares will be 31.34. Okay, the bonus issue will affect that one too. The bonus issue will affect the full market value, and the bonus issue will affect the share that has been done at 31 December. So it will, whenever there's a bonus issue and right issue, it will be affecting the shares that have been in existence before
from
that particular.
After.
Yeah. So what are the shares in existence before the issue was done? It will affect that one like that. Okay.
Please,
yes, please.
I think we can use 7/6 being the fraction of, let me see, the unit as a bonus fraction to adjust it as well.
No, the right issue is different from bonus issue. Right issue is not coming with any value. So that is why we normally use the right issue fraction. But since the bonus, that's why we use the bonus issue fraction. But since the right issue is coming with market value, then let's adjust the market value. That's why we always calculate the theoretical extra price. That's why we always calculate the theoretical extra price.
It seems what I'm saying, you're not getting. I use 7/6.
Okay.
That's when you are finding the total shares.
Yeah.
6 is at 10, and then 1 is at 7. So we use 7 over the total basic.
You get 42, isn't it?
Yeah.
Okay, that is if you want to calculate the total number of shares. But if you want to calculate the effect on on that one, it will not be applicable. People won't go.
Okay.
If I talk, say I'll be responsible for the day. All the wrong way. All right. So are they like, okay, assuming the shares were not like, will you use the 30 million shares? Yes, we will still use the 6 and that one. Okay. The fraction will always be calculated on the unit basis. Okay, so you still use the 6. But just that if you want to calculate the shares, it will be on only the 30. So the 6 will not be coming into the picture.
Okay.
No problem. I will see receipt too. Yeah. Which of the standards are not examinable in FR? Please, as far as FR is concerned, all the standards that are in the books there are examinable. So in getting, okay, it's 3. Okay, we have gotten that. Please, can you go over how we had the right issue fraction? The right issue fraction is always calculated as the cum right price, which is the price immediately before the right issue
Right.
divided by theoretical XY price.
It's right price.
So our cum right is 10 divided by theoretical XY price, which we have calculated to be 67. So
Over 7.
67 over 7. So this, if you put in a calculator, is 70 over 67. Okay, so that's how we calculate the. Please, it's not, you don't have to memorize. You see, you just have to understand the issue. So if you understand it, you will be seeing any special in the exam unless they want to disappoint you. Okay, because it has been a long time that the any special came in FR. But you will be seeing impairment also if all things being equal. You might be seeing impairment, you might be seeing revenue, you might be seeing non-current asset held for sale. You might see government grants. So just focus on those ones. You might see government grants. You might see impairment. Are you writing it? Okay. So you might be seeing leases. You might be seeing government grants. You might be seeing impairment. You might be seeing non-current asset held for sale. You might be seeing the earnings per share. You might be seeing revenue from contract with customers. And if they want to surprise you, maybe they can also bring IA-16, property, plant, and equipment, or maybe income tax. But whatever be the case, focus on these ones and master the rest. They can also try to surprise you on provisions, IA-37. Okay, so please, can you go over the last one, January 2? Okay, so at January to that particular date, okay, we have 30 million in existence, okay, and we have made a full market value of this. So our shares were 36 million, okay, before the right issue. The right issue is now 146. So 146 will be done on all these ones. Okay, so you'll be getting 6 plus the existing shares of 36. That will give you 42. Okay, so that is the one. So please, let's pay attention to that. The ratio should be your 4th question. Please read about the consolidation, the theory part. Okay, read about the consolidation part. Read about the consideration, the forms of consideration that we have. Okay, the forms of consideration that we have, and we can also have factors contributing to negative goodwill. So why would the company be having negative goodwill? So you can also read about that one. You can also read about the factors that determine significant influence. That was last 16, but I can still bring it for you. So let's be on that one. Okay, so they can also ask you what control is. Okay, what is control and what are the indicators of control? Okay, and they can also ask you the exemptions and what are the things that will be, you see, exemptions from preparing consolidated financial statement where the parent itself is a partially owned or wholly owned subsidiary of another company. Their securities are not traded in the public, or the company is not in the process of filing or to get listed ultimate. So read about those ones. They always
When the parent has published financial statement which has complied with.
Okay, so when an ultimate parent or subsidiary present that one, so let's look at this one for the 5 marks. Please don't go and consolidation. If it is statement of financial position, just add your figures. If it is statement of profit or loss, ask yourself, what is the post-acquisition period? Just put the parent figures together. Then you will now find the post-acquisition period figures for the subsidiary. If it is only 6 months, the parent will have a 6-month share of the profit. So just find the 6-month share. Or sometimes they might give you a pre-statement and also a post-statement. Let me talk about that one. Okay. The acquisition can be done on July 2019. Okay, the reporting date will be January 2. December. So what they can do is that they can give you a full year statement of the subsidiary. So they can give you a full year statement of a subsidiary, and they see that the revenue is 1,000. And they can give you an interim statement of profit or loss, where they will give you January to June. So they can give you January to June, and they will say the revenue for the subsidiary for that period was 400. In this case, you cannot apply the prorating, okay? Because the full year, which is January to December, is what? Is 1,000. But the first 6 months before the acquisition was 400. It means that the last 6 months will be 600, because 400 plus the last 6 months will give you the 1,000, which is the total. So you just subtract the figures from the figures of the total of the subsidiary, or for the year figure to get that one. Please, they can also bring you something like that. So you just have to be on the you just have to prepare for everything. The final account understand the standards very well, understand your IFRS 15, because for the final account, some of the standards are not, the adjustments are not as compared to if you are asked on the standard its own. So there can be an issue of revenue, which you'll be needing the 15. There can be issue.
Yes, sir. Please, can you go over the revenue more?
Or the revenue is a complex something on its own. So if I want to explain the revenue, I have to spend like maybe 30 minutes.
It's just like the one in the more question.
The revenue that we have done, the one that the sale will be, they will sell it to you, and you'll be paying at a later date.
I think the person was given a commission. And then he paid the 15. Yeah, I think it's a discount.
Okay, where the sales was made on retained basis, or?
No, this one, the person sell through an outlet.
Okay.
He sold 6 million through an outlet, and then the expiring date. Okay, that's sales on return basis.
Okay. There can also be a situation where the person will be selling as an agent. Okay. So if you are selling as an agent, the only thing that you can be entitled to is commission. Okay. And the last thing was on commission. The revenue was on commission 1. Okay. And the only thing that you can entitle to is commission. So maybe they have given you the sales to the value of 20 million. Okay. You have sold, you are getting 10 million, 10% as commission. So it means your commission will be 2 million. Okay. What the entity will do is that they will say that, okay, the cost price of the goods is 15 million. So they will debit revenue of 20 million, and they will credit revenue of 20 million and debit cost of sales of this one. The goods are not for you, so you can't recognize revenue to them. The only thing that you can recognize is what is the commission. So what you do is that you reverse this particular, the cash flow is always the indirect method. Okay. If you have cash flow will always be the indirect method. So the question will always give you the indirect method, where we start with profit before taxation, you add the depreciation and those items. You just have to reconcile the items one by one. So they will be giving you opening balances. Then you ask yourself, how was the closing balances calculated? So if you have PPE, okay, you have the PPE at the beginning. There was a depreciation will reduce the PPE. There was a revaluation, the revaluation will increase. There was a disposal will reduce. Then you now compare with the closing balance. The difference over there will mean that, okay, additional PP has been acquired, but you can see the cash flow, but it is not likely to be a cash flow because they want to focus on the examination of the standards. So mostly it is always the final account. It's always the final account. Okay, so you reverse the revenue of 20 million, reverse the cost of sales, and now record only your commission as the revenue. Okay, so yes, so that is it.
And there was one you use fraction.
That will be retained. That will be sell on retained basis, where we use markup and those ones.
Markup margin.
Yeah, that was retained basis. Okay, you can only recognize revenue when customer has accepted a full delivery or has accepted the goods in full, and there will not be any issue of what return. Okay, but where the sales are done on return basis, revenue should only be recognized after the expiring date of what? Of the
variable term.
Okay, yeah. Okay. Okay. So please, we cannot do much, and at least let's go there and make ourselves proud, and make God also proud. May the good Lord be with you, and
Thank you.
let's all hope for the best. Thank you for coming. I'll see you guys after the paper tomorrow. Okay.
Bye-bye.
All right.